Imagine having the opportunity to invest in the next big company. Before it becomes a household name, before it goes public, before millions of everyday investors can buy shares. That's one of the biggest attractions of private equity, the potential for higher returns. But there's another side to the story. Private equity investments often come with higher risk, less transparency, and one thing many investors underestimate: a lack of liquidity. Before investing your hard-earned money into private equity, there are some important questions you should ask. Because while private equity can be a powerful wealth-building tool, it's not the right fit for everyone. Today, we're going to cover 5 questions to ask before investing in private equity. Let's get started. Question number 1. Do I understand what I'm investing in? Private equity simply means investing in companies that are not publicly traded on a stock exchange. That sounds simple, but private equity can include private businesses, growth stage companies, buyout funds, venture capital funds, real estate investment partnerships, infrastructure funds, and other alternative investments. Ask yourself, do I understand how this investment makes money? What industry is it in? Who manages it? What are the biggest risks? Never invest simply because someone says it's exclusive. Understanding should always come before investing. Question number 2, how long will my money be locked up? This is where many investors get surprised. Unlike publicly traded stocks, private equity investments are often illiquid. That means you may not be able to access your money for years. Some investments have holding periods of 5, 7, or even 10 years. Ask yourself, if I suddenly need this money, can I get it back? If the answer is no, can I comfortably leave it invested for that long? Private equity may offer attractive long-term returns, but flexibility often comes at a cost. Liquidity has value. Don't underestimate it. I personally invested in 2 different private equity investments, both for 5 years, and both went bankrupt before maturing. If it wasn't for the dividends I received in the first 4 years, it would have been a total loss. I learned a very valuable lesson about these type of investments. Question number 3, what are all of the fees? Private equity investments often involve more fees than traditional stock or index fund investing. There may be management fees, performance fees, administrative expenses, acquisition costs, exit fees. Some funds even follow the well-known 2 and 20 model. That's approximately a 2% annual management fee and 20% of the investment profits above certain thresholds. Ask yourself, do I understand exactly what I'll be paying? Because every dollar spent on fees is a dollar that doesn't stay invested. High returns can still produce disappointing results if costs consume too much of the gains. Question number 4, how diversified is my overall portfolio? Private equity can provide diversification, but it shouldn't become your entire investment strategy. Ask yourself, how much of my total portfolio will be invested in private equity? If this investment performs poorly, will it significantly impact my retirement or long-term financial goals? Most financial professionals encourage diversification across multiple asset classes: stocks, bonds, cash, real estate, and for some investors, a carefully sized allocation to alternative investments like private equity. Diversification helps reduce the impact of any one investment going wrong. My 2 bad investments were both in real estate. Now I have at least 5 different types of investments to spread the risk around. Question number 5, am I investing for the right reasons? Private equity often carries an aura of exclusivity. People hear about billionaires, institutional investors, and elite investment funds. It's easy to think, if wealthy investors are doing it, I should too. But that's not a strategy. Ask yourself, am I investing because it fits my financial plan, or because I don't want to miss out? Fear of missing out can be just as dangerous in private markets as it is in public markets. Successful investing isn't about buying what's popular. It's about buying what aligns with your goals, timeline, and risk tolerance. Today's final thoughts. Investing in private equity is neither positive nor negative. It's simply an investment decision. For some investors, private equity can provide diversification and long-term growth opportunities. For others, the lack of liquidity, higher fees, and additional risk may outweigh the potential rewards. Before investing in private equity, ask 1. Do I understand what I'm investing in? 2. How long will my money be locked up? 3. What are all of the fees? 4. How diversified is my overall portfolio? 5. Am I investing for the right reasons? Because the goal isn't just investing in exclusive opportunities, it's building long-term wealth through informed decisions. In closing, if you found this helpful, subscribe to Quick Financial Concepts. We break down real financial decisions so you can avoid costly mistakes and make smarter money moves. And remember, the smartest investment isn't always the most exclusive. It's the one that fits your financial plan.